The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everybody. It's January 29th, and I'm Keith Harwood here for Yellow Tunnel and Tradespoon. Standard disclosures before we get started on the morning bell conversation. Options involve substantial risk and are not suitable for all investors. Tradespoon, Yellow Tunnel, myself are not investment advisors, not registered with the SEC nor FINRA. If you do have questions about your own personal financial situation, please consult with a registered financial advisor. The information in this presentation is for education and information purposes only and should not be considered trade advice. And finally, myself and or the team at Tradespoon and Yellow Tunnel may have a financial interest in the securities presented in the trade ideas, so please keep that in mind as you evaluate ideas that we discuss for your own personal investment and trading portfolio suitability. Morning, everybody. I hope you all slept well. We got a big day today with some big tech earnings tonight. We've got the Fed tonight. That does put a little bit of a extra issue potential for those normal earnings trades. We'll discuss that a little bit more as we go through this, but generally speaking, there was a major flight on Monday from a lot of these AI names and a lot of the power generation for AI names and data centers and things of that sort. It seems like the market has started to digest some ideas about DeepSeek. They're running some stocks that could really take advantage of that kind of technological advancement at a much cheaper rate if it all is what it is starting to look like it is. But at the end of the day, we got to get a little bit more information. I think market's still running with the idea that DeepSeek is going to overtake a lot of the other multi-billion-dollar investments with only a $6 million investment. So we'll see how that all goes, but there was definitely some fight in the market yesterday. Good sign for the bulls. Not everywhere. Didn't get a major recovery in a lot of names, but overall, we're seeing some interesting shifts in investment theses, to say the least. We got a big concept, I think, right now of probability of success versus return on capital. I think that the magnitude of the move creates a concern about the probability of success in those names that were impacted the most. It becomes a little bit more of a coin flip up or down, depending upon the market's digestion and understanding of the implications of DeepSeek and the like. When I think about NVIDIA, if they're now a step, if their semiconductors are now creating or no longer nearly as valuable, now nearly as useful for AI, what does that do to them? What do the other AI names do if they're now behind? Power generation was a big hit. There's a lot of different implications as we saw a lot of individual names get hit. Eaton, KMI and Williams companies got hit from the pipeline side. Just a lot of market shifts. And I think a big portion of that was that there was this thought process that the probability of success was very high for some of those names and people were overloaded in that position. Did we finish the liquidation? Maybe. Or the necessary liquidation, the risk part of it, maybe not. Maybe there's a little bit more to go. But there are other names that we can focus on that don't have as much to do with it. I talked yesterday near the close about regional banks. Regional banks really have no impact from this right now. So one that I was looking at yesterday and I'm looking to add this morning is Regions Financial. It just looks like a pretty good setup. It was on the aggressive power trader list from yesterday. So I'm thinking about adding that one this morning, barring some major shift here in the next hour, where it goes way down, or way up and prices me out of the trade. But I don't expect to see that happen given the current market conditions. And as I said, we've got the Fed this afternoon. Now, December 18th was a big hit on the market from the Fed. The market has concerns that that's going to be a repeat. It could set up an opportunity for two reasons. Number one, if the Fed repeats their inflation concern commentary and the market reacts negatively again. Last time, it wasn't necessarily a buying opportunity. We did a lot of chop afterwards, but we may see that there's an opportunity to play from short side. And if they lighten their verbiage and the market likes what they are hearing, it could actually create that next breakout in SPY. So certainly some uncertainty. That's what we can put it at. Of course, we also have big tech earnings like this afternoon, Tesla, Microsoft, Facebook, Meta, whatever, IBM. Tomorrow we got Apple. So there's a lot of news to digest here in the next 12 hours. And it's going to be interesting to see how the market behaves as a result for today and then setting up tomorrow. Yeah, I mean, those names that aren't really moving, I think, is where we can really allow more time by pushing the expiration month forward. A lot of stocks that are moving, the implied volatility is spiking because of the realized volatility and the uncertainty. Adding more time in those names tends to tell me that maybe my timing is actually off. So if I'm not sure of that trade coming to fruition in the next week or two, then maybe I'm better off waiting and reevaluating in a week or a day or a month, looking for when the probability of success is more in my favor. But that doesn't mean that I have to avoid allowing more time, but I can allow more time in names where implied volatility is near lows. And again, that goes, I think, back to some of those like financials, things like that. We did see a good VIX spike on Monday. It was a relatively extreme level, not a major extreme. If we do have a negative Fed today, we may see a major extreme on the VIX spike. So keep that in mind. Earnings dates, of course, we've discussed that. We've got earnings coming up this afternoon, tomorrow morning, tomorrow afternoon that are big. A few more next week. We got Alphabet next week, I know, for example. So this week and next are kind of big ones for the tech side on earnings. We've already gotten the financial earnings out of the way. So I like keeping that in mind. You know, for financials, you know, the biggest input right now is, of course, the Fed. But then we get a little bit of a lull and back to just some economic data and general market flow. Don't like revenge trading. You know, and I think some of that comes back from what the shifts we saw on Monday. We saw some extreme moves. So there are some trades around that. But doing it just because I lost money is a bad trading philosophy. Looking for a sign that I can make the trade is a much better strategy at this point. Showing some signs of overdone sell-off, finding value investors getting back in, et cetera, et cetera. That's going to be the bigger issue. So we got to look for signs of the bottoming process and those that got hit, and potentially a topping process where everybody's getting into some of those names that really performed. We looked at cybersecurity yesterday afternoon. That could be a sector that's getting a bit frothy, or it may be in the early innings of a rotation. We've got to look for the signs to let us know if we're in a continuation trade, or if that was just an oversized reaction for the information that we've currently got. With that, we got the 10-year yield shifting down towards 4.5. So testing our support level here, or my support level here. Yeah, it's the January 2nd low, really close here to the January 27th low from Monday. Testing it again today. We may see a move in the interest rates off of the Fed decision this afternoon. So I just got to watch that. And I'm more concerned about seeing interest rates going higher with inflationary comments. So if I see interest rates up around 4.7 or something crazy like that, for a one-day move, that is crazy for a one-day move, along with a inflation concern commentary, that's going to put some certain concern for me on the bull side. If we stay kind of between 4.45 and 4.6, I think that's okay. You know, if we breach 4.5, it gets a little bit more comfort for people overall. I don't worry necessarily about an economic recession being part of the commentary until we get down back towards 4%, if we ever get there. So that's where we're at right now. I think the bigger concern right now is if interest rates go too high, not too low. And yeah, Fred, I will say ETN looks okay early today. So that may be a sign that that move yesterday was overdone and widely driven by risk reduction behavior. So if portfolio managers had a heavy position in Eaton, once you get down to a level where you've hit your risk stops, it doesn't matter the value anymore. You got to get out. Risk managers exist for a reason to tell you you have to exit so that you don't do like, you know, I think for me, some of the more famous ones like Pershing Square sitting there, Bill Ackman continually buying, what was the symbol of it before it became Bosch, the health company? But anyway, it was going down. It was like a $200 stock that went all the way down to $9 before he got out. It was a disaster to continue to add on the break and then watch it go to $9 a share and force yourself out. He was fighting against the market for way too long, wasting all of his mental capital, investing in a thesis that just wasn't there anymore. And I think part of the problem for him was that it worked before during the subprime crisis. He did the same thing in Target and really made his name off of investing near the lows in Target because he kind of was buying right around the lows of the subprime crisis. But, you know, to each their own on it, I guess. That's the difficulty with value investing versus trend trading. Value investors tend to look for lower prices being a better buying opportunity, and trend traders are looking for higher prices to generate a better signal of market flow and a better entry opportunity. So if your thesis is based upon fundamental valuation being too low, you got to wait for the fundamental input to come in that shifts the money flow, or the other value investor to come in and say the same thing, and then get the technical traders on board. Or you may just be continually convincing yourself that if I liked it for, $300 a share, I'm going to love it for 200. And if I loved it for 200, I really got to love it for 100. And if I really loved it for 100, man, at $9, this is a steal. At the end of the day, there's a lot of losses along the way getting into that sort of situation. Let's do Bitcoin. Little risk on barometer for today. We had the dip on Monday, but it got bought back. Yesterday, it looked okay. We were sitting in that 102 range, drifted down towards 101, close to 100 by the close. Today, back up a little bit, up $1,700, sitting at 102 and change. Overall, it's not really going anywhere right now. Again, the Fed actually may be enough of an input to get Bitcoin buyers in there, especially if we end up with like a weak dollar off of it. So if we get a weak dollar, Bitcoin starts to recover back towards 107. That's going to really, I think, be the element that gets people excited. But I think market participants in general are a little bit leery of high risk, momentum-based tech growth assets, and crypto gets kind of bucketed into that. So it's going to be a little bit harder for Bitcoin to break out to new highs if people are still leery about tech. Maybe that gets cleared up with some of the big tech earnings, but I think it's more likely to get cleared up as we start to see earnings from, Palantir and AI names, things like that just have a little bit more of that speculative long-term growth potential in the tech space. And of course, MMFI. There we go, MMFI. So just looking to make sure that we're not getting a big shift in overall market breadth. MMFI gives us the the percentage of stocks that are above the 50-day moving average. It's about half right now. That's not overbought. It's not oversold. There's still some stock selectivity going out there. Some stocks going back under, some stocks going back over, hanging in the middle. When we get into a really frothy condition where the market's getting overbought, like 70s can be a concern. On the sell-off side, 30 sort of acts similar to an RSI type barometer for the market, but it looks at where the market participation is. When you get to 70%, it means 70% of stocks in the universe are showing signs of bullishness. And if 70% of the companies out there are truly bullish, which ones do you pick? It really just means the market's buying everything and it's forcing too many stocks into a bullish looking trend that just doesn't exist. And when you get down to 30, it's not all garbage unless you're in a major economic recession. All right. So S&P today, this morning, pretty unchanged. Non-event so far. Again, this is going to be an afternoon thing for me to see what the SPY looks like. And that's going to be built off of the Fed. If the Fed decision comes in and we start dropping, and we start looking like a repeat of December 18th, then I start thinking about the scenario that occurred then, where we got a couple of days of fall through, a bounce, and then a chop. Seems likely that we don't have a bull market for at least 3 weeks, maybe longer, if we get a negative Fed. When we've had negative non-farm payrolls, we had a spike and then consolidation. Very difficult rally to dip to buy there. Then we had non-farm payrolls pull us down again, jump back, sit. We got non-farm payrolls coming up as well next week. Maybe that could actually create another similar sort of scenario if we see economic indication of less growth than we're predicting. So you got a lot of data right now. Economic data is having a bigger shift on the markets that I think it had for a long time. For a long time, it was good or bad, it doesn't matter. The market's going up. Now economic data actually matters to the market, and we're getting reactions in line with what the data says, which is kind of nice. As we go to the VIX, up a little bit today, 1675. So let's go to 3 months so I can trim that out. So you can see the spike that happened on Monday up to about 22.5. The spike on the Fed last time was up towards 30. Little spike here in the middle of January before it came back down. If everything settles in post-Fed with a generally bullish market, I'm looking for the VIX to get down to 14 or a little bit lower. If it's negative, I think we're looking back to 30. So the VIX has some movement potential here over the coming, week. Really built upon what the Fed does today. And if there's any more news that comes out of this whole DeepSeek evaluation, maybe something there can shift that. Skew had come up quite a bit. So here we go. Again, 3 months. Sorry about that. So he had to come up quite a bit. Not huge spike, but it did come up as people panic bought puts during that liquidation mode. That didn't turn out to be major liquidation mode for the broad market, but it was a concern. So people started buying out of the money puts. Now, as the skew starts to come back down, it starts to look back like people are going to be buying put spreads heading into the Fed. If the skew dex comes back down towards 56.5, 57 range, with the VIX stable, it means people are buying put spreads. If we see skew dex flat with VIX down, they're selling put spreads. So just got to watch, what skew dex is doing in relation to it to get an indication of what market flow is. And it had been certainly buying out of the money puts. And then the VIX came down. So people started selling some put spreads or maybe selling some calls against the puts that they had bought in order to reduce the capital outlay for that hedge. I'll just check on Delta right now for the morning. Yeah, so Delta's in very good shape this morning, up 60 more cents. Just a reminder, I'm in the 64.66. It was a per credit spread for about 45 cents. I should double check exactly what the price was off the top of my head. I was thinking 45, but it was 46 cents. I got a 46-cent credit. I'm going to look to close it out as it gets towards a nickel. Doubt it'll happen today unless Delta decides to go to like $70 a share. But as we come into the day tomorrow, it just slowly decays over time. It's about a 12 cent, 13 cent put spread right now. That can decay to a dime or lower, probably about a dime if we just sit all day today at this price point. And as you can see, if we rally about a buck and a half from here, that would do it off of the Delta, just getting away from the 66 strike. So the Delta of the Delta. Let's go back to tech. So we got tech, Q's kind of unchanged here too. So remember SPY, we had made the new high, came back, and now we're really testing that level from Friday. Friday's close was 608. So, we're within striking distance there of both Friday's close and a new high. We're within striking distance of Friday's close, but the new high doesn't come until about 540 in tech. I don't think that's happening today. Maybe with the combination of a bullish Fed and bullish earnings from, Tesla, Microsoft, Meta, and IBM, that could be enough. Apple tomorrow is going to be a big part of it. We know Apple had a just terrible run, and then they were one of the benefactors of the DeepSeek announcement because people talk about how they can leverage DeepSeek's technology to produce a better product that then allows them to make more money. So the end consumer of AI is the one that that benefits from this technological advances, and those that are the competitors get hurt. And that's what we saw. Semiconductors broadly got smoked. New high and then lower than the lows of the range of the last 4 months. All right, so we went to the new high here on the last 6 months. Remember that back in July we were higher. But over the last 6 months, that was a new high. And then we went to about to a 4 month low 24 hours later. So or I guess it was a weekend, but you get the idea. One trading day, 2 trading days away between a 6 month high and a 4 month low. It's been a very range bound trade in semiconductors. We'll see if this support can start to hold here after we shot through it, but bounce back. Getting above the 200-day moving average would be a help there. And I think a lot of it's going to have to do with NVIDIA. If NVIDIA can bounce back above 130, that'll generate some confidence in the semiconductor investment money flow. But right now, it's a very dicey trade, very, I think, heavily risky, unless you have a very defined stop using, the lows of this move. So I think in order to have a reasonable risk profile on this, I got to use the lows of this move, yesterday's low, as my stop out point. If it's SMH, it means I'm risking $8 to maybe try to get to 260 and make 20. So the R&R is there, but it's not actually nearly as massive as I think maybe some may think, because there's enough risk there at $8 that I'm offsetting some of that potential profit, 2.5 to 1, but that's assuming that we get a full recovery back towards the highs in the 4-month range. And then small caps, just chilling, right? No real impact. They're not heavily tech focused overall. XLF has been grinding out those gains, looking like it wants to break out to a new high. 51.62 is the previous high. 51.55 was yesterday's high. We're just below it. We're towing against it. The market may be just pausing, waiting for the Fed to come in with their input, because we know the financials get hurt, just like everything, if we've got a negative Fed. So December 18th was bad, not as bad as it was for some other sectors, but it was still bad for financials. And so people, I think, oftentimes start to wonder, do I want to hold at the highs with an announcement coming, or am I better off to just take the profits here and then re-engage post-Fed? Creates a natural inflection point, but we've got a clock on that. 6 hours from now, we'll know the answers. All right. And that's my main sector stuff. Let's go through, we'll do yesterday's earnings first. So Starbucks, bullish, breaking out to a new high, $106 now. So the initial reaction was bullish, went to about 104, 105 last night, then pulled back to $100, looked like it was a non-event. And now we're getting good follow through. To me, there's not much to do here other than to just kind of note that it was pretty in line with the normal expectations and the normal returns so far. I think the next leg in Starbucks is really going to be driven by, again, just broad market flow. Bullish Fed, we get continuation. Bearish Fed, this may pull back to $100 a share. But there's not enough premium to bet on, like, we're going to stay above 100 through the end of the week. I mean, sure, I can make a dime. So on the 198 put spread, it just seems like asymmetrically bad tail risk, to only collect a dime on that. I then have to work on making sure I probably exit it before expiration for a couple of cents. I'm just going to end up chopping around for very little money, but using up trading capital because of the margin there. So I don't like anything in Starbucks right now, but I think it's good to note that it was bullish. ASML had looked really bad post DeepSeek, and it recovered. So that's a good thing. One of our first signs maybe of, generally okay situation. They've got, there it is, advanced semiconductor equipment. So for those that were not as aware on ASML, semiconductors, a generally bullish, bearish one, had really bad earnings in October and now starting to bounce back. We had Texan, just as a note, that they had their earnings and had a negative reaction, and they're still chilling at the lows. And DeepSeek didn't help them, obviously. Didn't initially hurt them, but then yesterday it got pushed down a little bit lower. PGR was one of the two that I was looking at as a possible trade here for an iron condor. The idea was that it needed to stay between 230 and 260. And so we're sitting at 248. So that looks pretty much perfect. The 260s are closing in on worthless. They probably will be by the end of the day. The 230s may be worthless by the end of the day. I honestly don't know why there are still bids on like the 220s and 222 and a half. It might just be a liquidity based thing. Usually I'd expect the market makers to just come in and start slamming those out, but they haven't done it yet. It's not a heavily traded option market, so maybe they're just not paying attention yet, but I expect all that stuff to get cleared out and that iron condor to go to zero over the course of the next, close to zero by the end of the day today, officially a zero on Friday, unless we get a major market move. ADP was the other one I was looking for a range bound trade between 285 and 315. So a little bit more on the upside here, 3.8%. Pretty in line with expectations and a little bit more than the norm. But overall, it stayed in that range. And so the iron condor is looking okay right now. It's a little bit dicier. The 315s have some value. Right now it's basically a break even on the iron condor until this premium starts to suck out and people get confidence that we're not going to explode higher for ADP. And so as we get through the first hour or so of the day and that implied volatility comes in, that should bring the iron condor in. But so far, that one's more of a break even. Just seeing that CCJ, I want to check uranium real quick. So, people looking at the nuclear thesis, uranium bouncing back a little here. There was a buyer of the March 60s in CCJ just now. Actually, may not have been. Implied volatility is up small. So, looks like somebody's looking to do something slightly bullish so far, but I don't really see anything yet here after the fall. Just a moment. All right, let's see what else we've got going on here for today. New aggressive power trader ideas. We got CME. I don't see a ton here. I think if we get a bull flag, it gets more interesting. So we're starting to get a little bit of that behavior, the spike and then the little profit taking and then a recovery and then pullback. So, for me, I don't see anything there on the open today. HCA looks a little bit better. We had bullish earn, I guess it's before market. So we had a little bit bearish and then recovery. This looks like people are trying to go for it based upon maybe some AI utilization. And if we can get above yesterday's high in particular, it starts to get intriguing for a move to like 355. But HCA looks decent. And then Morgan Stanley. So, back to the banks. Morgan Stanley breaking out today. We're getting some financial money flow here. So financials are still looking generally good. Let's go to the regionals. Regionals are back above the 50-day moving average. RF up about 20 cents this morning. These are probably 80 cents. They're up to 85. Ugh. Should have bought them yesterday for 75, but that's for me still. This looks pretty good. If we hold up here about near the 50-day moving average, I'll still look to go into RF for a week or two, depending upon what happens with the Fed this afternoon. If we get a negative Fed, I may have to be out. And if we get a positive Fed, I may be out just from profit taking if we shoot through my price targets. So, we can check through those. JP Morgan already up $2. Nice. So JP Morgan, those in the money calls are up to almost $10 now, or sorry, $8 now, the 265s. So those are looking pretty good. Got Google. This is going to be impacted somewhat by the earnings coming up this afternoon and tomorrow afternoon. So we've got, again, Tesla, Microsoft, Meta, IBM all this afternoon. We've got Apple tomorrow afternoon. If bullish tech earnings come out, Google will trade a bit. Google will trade a bit off of the correlations, but the earnings premium will stay in the options, so it shouldn't have a drastic impact. And even if Apple and Microsoft are both negative, for example, it doesn't mean Google's going to liquidate. It just might increase the probability in people's eyes that Google is going to be a negative earnings announcement. So we've got to watch it, but it's not as concerning there. And then what was my third? Why am I blanking here? Oh, right. Twilio, of course. So a little bit of profit taking to start the day here. Nothing too major yet. So it's in amidst a bull trend. Kind of reminds me of BSX from last week, where we were getting these little profit taking windows, but you just continue to appreciate as people just believe in the stock. So once it's in that trend mode and continuing to see people acquiring, yes, it becomes at risk of an asymmetric move to the downside. If news comes out that's negative, it requires risk off because it means people are going to be heavily loaded long. But for now, it still looks like it's holding the trend pretty well. So I like all of those still for at least for now. Let's go into the afternoon's earnings. And if there's anything you guys are looking at that's particularly interesting to you, definitely let me know. Take a look at them with you. But Tesla earnings. So our average move in Tesla is 12%. We had a 22%er. We had some 10%ers. And we are implying an 8% move. The smallest move we've had in the last 2 years is 10%. Well, I guess 9.3%. In the last 3 years, we've had 2 earnings under current implieds. So again, we're implying 8%. We've only had 2 times where we moved less than 8%. So it looks like the options are undervalued here to me in Tesla. I'm looking for something a bit bigger on the move. If we want to see a fairly traditional 12%, that would, I think, be most likely the norm, but we've got the Fed too. So if I've got bullish Tesla, bullish Fed, we may see 15 or 16%. If I've got bearish Tesla, bearish Fed, that could be 15, 16%. And if I've got bullish Tesla, bearish Fed, that's, I think, where we get into a potential for a little lower move. So bullish Tesla with a bearish Fed, maybe we only go up 6% or 7%. But if they can compound upon each other and go the same direction, we can get that bigger move. 12% is $48. 440 looks like a pretty good target point right now. 12% down again, $48 puts us at 344. So right around that 340 level, looks like there should be some support. With the options priced cheaply, I think this just goes back towards looking for a double fly and staying a bit wide. Maybe $15 wide, going like 35.5, 355, 340, 325 on the put side. Going to end up being about 40, about $1.50. So if I did symmetry and went for 440 on the upside, should be seeing about the same. The 25.40, that's a credit. And then about $1 and so about $1.50 to $3 for the double fly, $15 wides. There is some really big open interest actually on that 440 strike, so keep that in mind as well. 30,000 open interest does make that look more and more like a target. So if I'm just going again for that, like the traditional size move, 340 is a little bit less of a sticky point on the downside. Bigger sticky point might be 350 here, but for that symmetry relative to 440, I like being in that 340, 345 range and staying with like a wider fly, like the 355, 340, 330, 325 allows me to get some profit if we even were on the breaking side down to only 360 or 355. So Tesla looks somewhat interesting for that double fly, especially with implied volatility, expecting more of a 7 to 8% move. Microsoft has been a bit wild here. So broke, recovered, went right back to the highs, fallen off a little bit pre-earnings. Normally moves about 3%, normally gets priced in around 4.5%. We've had some movers, 7%, 6%. One of the things that concerns me about a potential for a bigger move in Microsoft is if they have to start answering questions about AI and DeepSeek, that may start to make people wonder how you're going to utilize it and while they'll have some sort of answers on AI with the relative newness of the announcement here, they're not going to have a fully prepared response nearly, because we don't know enough about DeepSeek. I mean, we're making a lot of speculative guesses here based upon their announcement on Sunday, and people just don't know, is what it really comes down to. Not you, not I, not anybody, except for maybe the people that built DeepSeek. Nobody really knows exactly how powerful this tool is and how big the advancement is until they start digging into the nuts and bolts of it and see how it works and see the use cases. So given that we don't have that information, I'm a little leery of Microsoft having a potential for a big reaction to basically an uncertain response to that situation. Meta's sitting at highs. They're expected to be, again, user of AI. Normally like a 7%, but we've had a couple of 20% plus moves here. It gets a little bit dicey trying to trade that with 3 inputs coming at once: Meta earnings, FOMC, and reaction to the AI advancements. So I tend to think that one's more of a walk away, especially with sitting at all-time highs. I don't have serious support and resistance. IBM, on the other hand, does look like it should have a good technical formation here. Their earnings traditionally are about 5%. Their stock has had a very muted response. So 5% for them goes to 240, which is right at the previous high. Downside, right around 215, which is, lo and behold, the January low. So 215, 240 looks really attractive in IBM. I think this is a double fly just because we have such defined levels there. Up 12.5, down 12.5. That's right between 5 and 6%. The earnings have normally been right between 5 and 6% or right around 5% on average. And yeah, sometimes we shoot up to 9%. But with the previous high and this recent low as good technical indicator levels, I like that double fly. So thinking, just staying reasonable with $5 wide. Let it appreciate if I get it right, and get it really cheap if I'm wrong. So, 435, it's about 4.25 minus 4/10, so 15 cents. I got the wrong strike there. There we go, 215. Got to get new glasses. So that's about $5.50 for 2 of them. So that's going to be about $1.25 credit. So about 40 cents for the put fly. Similar call fly should be around 40 cents without doing the hard math on it right now. And but we're looking at $6.50 credit. Yeah, about 50 cents. So 40 to 50 cents for each $5 wide fly, targeting 215, 240. I think makes a lot of sense in IBM. So that's maybe the best of the earnings ideas, I think, for today, in my opinion. IBM just has, I think, the most, reasonable target price points there, given the symmetry and the normal move. Yeah, I mean, that is, I think that's an actual risk. What if DeepSeek is a lie? We don't know what DeepSeek really is. I mean, what if they come out and say, gotcha? I mean, that's the conspiracy theorist in me, or the questioning the reality on it is part of what we do, right? Like, naturally, as we're evaluating stocks and things, you have to question what people are actually achieving versus what they're saying they are, because while the market price is always correct, it doesn't mean it's the price in the future. So right now we're trying to predict where it's going to go, and I don't know where DeepSeek is going to go. I'm glad that they ripped off the Band-Aid and announced it, but there's going to be months of analysis that has to go into figuring out if it's really real and what it does. So in the far category of it, is it real? The other possibility, I mean, a guy I worked with was talking about, he's like, well, what if they were only able to develop it for $6 million because they just stole the technology? There's something to that, right? I mean, we don't know how they got to that point for so cheap. And maybe they are just brilliant, and that's the other side of it. And if they're that brilliant, man, I wish the other, brilliant employees of some of these other companies were able to figure it out, but good on DeepSeek for figuring out what others couldn't. So, it could be any of these scenarios. We can, we'll find out over time, I'm sure. But for now, there's not a lot of known. It's a lot of unknown paired with the limited known that we just picked up. Yeah, exactly. I mean, unfortunately, we've got a number of cases where Chinese companies have stolen technology. I'm not saying that it's guaranteed that they've done it again, but there have been enough scenarios where you could say that has to be a legitimate question mark, knowing nothing about the people that developed DeepSeek. So, it's something that has to be weighed in as a potential answer, along with all of the litany of other possible answers here, including like I said, that they might just be geniuses that figured out what others could not, and if so, good on them, right? UPS. So one of the things I'm a little worried about with UPS for their earnings is the way that they reacted last time. We had bullish earnings, pulled back, and then just drifted back down. It wasn't like a move and then stick by any means. We've normally had about 6% moves, but as you look at the stock chart for that last earnings, it was not a 6% move. It was a 6% move by the close. And we only went up from 131 to 138, but on the open, we were at 145. So we had a $14 move on the earnings initially, about an 11% move. It's just half of it went away during the earnings day. So again, I think that this is, to a certain extent, it's underpriced, but using a double fly to play for underpriced movement is very difficult in this scenario. Because if it's not a sticky move, then if we go move 10%, I don't know if we're going to just completely unwind half of that by the end of the day because of other inputs. So I kind of like avoiding UPS because of the lack of stickiness to it. I don't think it's priced high enough in the expected move to want to get aggressive with an iron condor, and I don't want to go sticky with a double fly. And at the same point, I still don't want to and I rarely, if ever, go out and just buy a straddle for earnings. So if that's your style, good luck to you on it. It could be a good winner. It could be a loser. From normal realized and implied volatilities, we're right in line. So it's just about expecting something in UPS's earnings this time that the market's not aware of, I guess. So MasterCard sitting near the highs. These credit card companies have been doing very well. This is usually a pretty small mover of about 2 to 3%. It goes back to just, if I wanted to be somewhat concerned about the Fed's impact on financials, maybe that could drive a bigger move. We got about an $18 straddle, so just over 3% for the week. And that includes the Fed, 2 to 3% for earnings. I think this is kind of a non-event there as well, but I just needed to bring it up for you guys that I'm not looking for anything there. Caterpillar has been on a bit of a tear here, 3% mover on the norm for earnings, but we've had, 3 of these 2 standard deviation range moves, right? 2 standard deviation relative to implied, not relative to realized actuals. So, we can get 8%. We could see 3%. If we were to go for the 8%er, that's 430. That's a new all-time high. On the downside, it's about 365. Kind of right in this range of consolidation, right above the 208 moving average, the end of the year level. If we only get 3%, we're looking at like $10. So, boop, last week's high, or down to 385, no man's land. It's a coin flip whether we get the big move or the small move. I'd lean towards a big move. There's no open interest in the big move on the upside. No open interest outside of maybe the 360 put on the downside. Maybe there's a flyer trade here, but the market's not particularly tight. But, I could go like a 370, 360, 350 put fly. It's going to be cheap at least. And if it works out, great. And if it doesn't, it's not much skin off my back. So $1.30 versus, call it 70 cents. The bid is low here. So maybe 70 cents. So about a nickel credit. So Sorry, I was looking at the 362.5, not 360. I got to get in for the eye doctor appointment. So there you go, a dime. Those should be probably about, 35 cents on the put fly, likely around the same on the call fly for a 440 target. And actually 440 is even less liquid and cheaper. Might have to go to 435. But again, I got to wait for these markets to tighten up to have a real opinion, I think, in Caterpillar. Yeah, I mean, a fly or trade maybe for the double fly and nothing else. It's not an iron condor because we've had those 8, 9, 10% moves. I don't want to go iron condor since they've happened frequently enough that I don't want to get in that. And then love. So we've seen a bit of volatility in some of the airlines earnings. We had United unchanged, bullish and then pulled back. Delta, bullish, stayed, and then continued. On the other side, we had JetBlue yesterday, bearish, real bad, and looking like it may want to continue lower. So it depends upon where you want to bucket Southwest. I tend to look at it kind of with American. So like United and Delta look like they trade pretty comparably to each other. American, something between love and those two, and then love a little bit weaker recently. They are going through some fundamental shift. They've got some activist investor involvement. Maybe that could spark some interest to push it towards these highs around 35. That would be 10%. 10% would be the 2 standard deviation move. I would not be surprised to see it. So given a potential for a 10% move to the upside 35, 10% downside to 30, those look like some decent support levels right here at the lows outside of their last earnings. They bounced back to 35 and hung out there before running all the way up to 36. The options, not much. 35 is a teeny option. 30 is, sorry, not 30, 3.5. I should be looking at 28.5. So what's 28.5 look like? So that is the earnings low. Okay, so 28.5, teeny option. That's for my 10% move. I would do this not as a double fly. In that case, I would just go for like a cheap buying an iron condor. If I could get the 20, or sorry, let's say the 30, actually probably just a put, yes, I'd reduce my cost by 6 cents, but maybe just a put for 26 cents on the 30 strike, a call on the 33.5 strike for 29 cents, paying about 55 cents. It's not too much premium for me. If that's more than you want to spend, then I would avoid love, but it's 55 cents and it is a less than coin flip probability, maybe like 35% chance of getting an outsized move that triples my money. So it's about a break even, but if I'm thinking that there's a greater than about 1 in 3 chance of a big move, then it's worth it. If it's less than 1 in 3 chance, it is not. I tend to think this might be, statistically, it's probably 1 in 3 at best, but my, sort of bias is that this may be a time where we get a little bit of movement in love, especially given the magnitude of the move in JetBlue. So just a strangle could work very easily there. To cheapen it, I could again do that iron condor, selling out the 35 put, selling out the 28.5 put, reducing my expenditure by about 14 cents and saying that I'm not playing for the move to a real outsized mover like 36 or 27. But I get a little more freedom if I go through the just strangle and we do get the move. And if we get a move to 30 or 33.5, I should be close to a break even anyway. So if I only get 5%, the norm, I'm okay. But if I get 10%, that's where I really pay off. Okay. So 5% is kind of my break even. 10%, I can triple my money. And that's what I'd be looking for love. So I'm thinking like strangle in love. But the IBM trade to me looks like the best setup on the earnings analysis for tonight and tomorrow, particularly with an extra potential kicker out of the Fed. Let me look at Apple again here. So I'm trying to get ready for an Apple earnings is tomorrow after the close. We've seen some minor moves and some bigger moves. We're expecting a pretty average move. So the market's not sure if we're going to not move or we're going to move. I tend to think we're probably going to move a bit on Apple. Particularly given the move of the last 2 days, Apple, and then prior to that, the previous month, we had a month down and then a 2-day recovery. I'm kind of leaning towards, I tend to lean towards the move, which is what the market's pricing in. So as it currently stands, I don't see a big trade in Apple, but I'll keep looking. If we get 6%, it's about, is that 12 plus? Yeah, so 15-ish bucks gets us close to those previous all-time highs. Downside 220, right to the previous lows, right to the 200-day moving average. The options set for it. I mean, it's a cheap double fly. 220 and 250 or 255 range, cheap double fly. We've got very spread open interest. I think that speaks to the uncertainty of lack of movement or big movement. There's not a big strike that is keyed in on. It also speaks to the move we've already had, people trading for that up and down move over the last month. Right now, I don't see an obvious trade, but again, it could be an outsized, like little cheapy double fly, looking for it to pay off, 1 in 4 times. And if it does, I get a winner. I know a lot of people like to have that Apple trade. I got to think through it more. It would be a trade that the Fed announcement's already in. So if there is a big price movement off of the Fed and or off of Microsoft, Tesla, IBM, and Meta earnings, that may shift my thinking a bit. But for now, it's in evaluation mode for me. I don't see anything completely obvious yet, to be perfectly honest. All right. What do we got moving this morning outside of that? I didn't touch on T-Mobile. They had earnings as well, T-Mobile. So bullish reaction on their earnings. Went up to 240, up 8%. It's a big move for them. This is a stock kind of like Apple, where it normally either moved nothing or up to about 6%, and this time we got 8%. Oh, 230 for a credit spread. Not enough for this week. I think if there's anything in T-Mobile, let's wait till post-Fed, make sure it doesn't get liquidated. And if it does, then I start looking for a credit spread for next week, saying we stay above 230. 230 is a little bit risky, but it's not terrible. Last earnings we were bullish and then kind of pulled and then continued the pull trend. So as long as there's not a overall market dynamic causing a pullback in T-Mobile and everything as a headwind, there may be something there with a put credit spread post earnings. But again, I think that's more of a tomorrow trade than a today trade. VFC, D-Dog, Tiva, Solar getting bid up today. Didn't see any news. This might just be that buying in some stuff that got cheap. First Solar still looks bearish, but it's bouncing. TAN bouncing. The 50-day moving average has been generally a pretty good entry point for the bear, or re-engagement point for the bear. We did try to spike above it back on January 7th, right in the beginning of the new year when we had a run on solar names. How's Sunrun look? That had been looking better. Yeah, it's still using the 50-day moving average as resistance. Maybe getting close to setting up a trade on the bear side for solar. But for now, I don't see anything major there. Let's go over to sector stuff. So TAN's the big mover, which is the solar ETF. Silver, up 50 cents today, pressing that inflection point. So we're right at the 100-day moving average. You can see we rejected that multiple times here already this month. On the way down, we played around with it and then bounced a number of times before ultimately finally pushing through. This could be setting up similarly. I think we're at an inflection point more than anything. FXY. It's going to be Fed driven, unfortunately. So probably not looking for a trade there unless there's like a cheap option for this week, which is unlikely given that we got a Fed announcement. Yeah, 50 implied vol. So 50% implied volatility is all about the fact that we've got potential for that move that people are looking for. If we reject, maybe we can get back down towards 27. If we follow through, we might be able to go to 29. So it is probably a bit cheap here on that 28 sort of straddle, or the 28 and a half strangle. But we got to see that movement off the Fed. And if the Fed's a non-event, that may not trigger anything. I often look for the dollar here as well. So look at dollar on the whole. Lack of dollar weakness would be an indication. So we got a little bit of dollar strength with silver strength. That's a divergence there. USD JPY. So dollar yen, often a big indicator on those precious metals. And we do have a little bit of weakness there. That's, again, consolidating, really approaching an inflection point. Will the 50-day moving average hold, or will we push back above the 10 and 20-day moving average, creating the bearish scenario? So I got to think that silver is at an inflection point here. It's more that the options, even though they're expensive, may be a bit cheap. Oh, sorry, that's January 29th. So that's today's options. I forgot they did dailies here. So or every other day, Monday, Wednesday, Friday options. So for the 28th strangle, it doesn't look nearly as attractive. You can go to February 7th. No, not attractive with the 80-cent strangle on the 20 and a half. So yeah, post-Fed trade. But it's nice to see silver trying to catch up to gold. It's got a lot of room to run there. If China continues to be bullish, which it's looking like a nice trend beginning here, then that could set up silver to continue to catch up. Or I could just go for some of the China names, JD.com. It's at some nice bullish flow here. Alibaba, bullish. Baidu, generally bullish here. Again, at an inflection point, we're right at the 200-day moving average. If it pushes through, we may start to look for a parabolic move to the upside. If it rejects, looking for 82 and a half. So once we get some clarity on that, I think on the call side, probably buying an outright call, maybe a call spread targeting 100 if you want to be a little bit more risk averse. 100, and then if it goes parabolic, I don't get paid not quite as much, but at least I get something for $1.25 call spread. To be determined though, right? So we got to see the China follow through overall and the Baidu follow through. But Baidu could be an interesting avenue to play China here. Oh, yeah. So the double fly, Chuck, the example would be in IBM, buying a put fly and buying a call fly for earnings. So the two strategies I normally look at the most for earnings are either the double fly. So it'd be buying the 220 put, selling two of the 215 put, buying one of the 210 put, and as a pair, buying the 235 call, selling two of the 240 call, and buying one of the 245 calls. And that's all about trying to pinpoint the move to either 240 or 215. All right. And that's based upon some traditional normal type moves around 5%. Alternatively, I look at like the iron condor. So like yesterday I was talking about, I'll just call it PGR as the iron condor, one of the iron condor type trades, looking for it to not go below 230. And so I was looking at like, say, selling of the 230, 225 put spread and selling the 260, 265 call spread as a pair. Oftentimes on the earnings announcements, either alternative when I'm looking for the move trades at around 20% of the max value of either. So it's all about choosing whether I think that the potential move is likely to be smaller than what we're looking at in the market. So if we stay range bound, I'm risking, say, $4 to make a buck by selling the iron condor. And if I go for a double fly, I'm still risking $1 to make $4. So it's the opposite. I'm risking 20% of the max value to try to achieve, realistically, not the full max value, but maybe I can get to 70, 80% of the max value. And if I get real lucky, I can go to 85 or 90% of the max value. So it's about just trying to balance out that, are we likely to move the amount we normally do? Are we likely to move a limited amount relative to the market implieds? And, PGR was pricing in 4% and just looks like a stock that was more likely to stay below 260, really below 255, and stay above that 230 level, which was the low from January 13th, as good support and resistance levels. So we started off yesterday at 245, dropped to about 238. We're range bound here. Iron Condor turning out right. IBM looking for a potential to move to 215 or to 240, to the low or to the high, because that's just been kind of our average move. Okay. ETN. Yeah, so that is the play that I'm thinking makes a lot of sense for ETN. Credit put spread being the idea of staying above $300. We have the higher high and higher low today, showing that this move to 300, at least for now, looks like a kind of crazy reaction. A 300 295 put spread for this week, so just not making a new low, is about $1.30. Do I think that there is greater than 26% chance that we make a new low? Personally, I don't. That's the strategy that I would be looking for ETN for this week. I mean, the Fed, if we go through a major bear move for the market, maybe we see that kind of drop again, unfortunately. But if I'm willing to take the Fed risk, credit spread in ETN saying stay above the range from yesterday looks attractive. There is risk there, but it is not crazy risk. I think that 300 295 put spread is an interesting one. Implied volatility is up to 100% in ETN. This is a stock that normally moves around 40, 42%. The normal implied volatility in the long term is even lower, 37, 32%. That 40% is based upon the fact that we just had such a wild move. So you can see here, it's a 25% stock, maybe 30% stock. So if this move is behind us and this starts to tighten up its ranges back to its norm, it looks like the options to me are a bit overpriced. We do have some uncertainty, but it's waning. It's calming back down. So for $1.30, I think that's attractive. If it got down to like $1 same day, I might be willing to just say, I'll take my, 30 cents and go, be done with it. But if it stays where it is, it looks okay. I think the liquidation's looking like it's done. It's not calling a bottom like I would have been if I tried to buy in at 300 yesterday. It's saying the market bottoming process is going into action here. So, yeah, I mean, frankly, I think that's, to me, that seems like it's a little bit riskier because it didn't have the bounce back of it like NVIDIA did after the major liquidation. Although NVIDIA now a little bit weaker, same sort of idea would be, kind of looking for it to stay above 115 for this week. But 115, 113 put credit spread's only 15 cents. So about 7% of the max value. The ETN trade is about 26% of the max value. So the R&R is much more there in ETN than it is in like an NVIDIA. But NVIDIA had a much stronger response. I mean, to get the same 26% for NVIDIA, I'd have to probably bet for, staying above 120. It's about 40 cents on that put credit spread. That's about 20% of the max value. And 120 is a little more dicey in terms of the technicals here because the lows were down to 117. So I think ETN has a little bit better defined low end risk there and a little bit more premium to collect as a result. All right. So ETN put credit spread again. I mean, for those of you that have been around for a while, I like to look for those with the momentum for the upside to buy outright calls and things. And, there's a lot of names out there, though, right now that just seem to be setting up more of a put credit spread trade because of the lack of trend that we've had in a lot of these names. Where we do start to see some trends, yesterday Bug jumped to the highs, consolidating a little bit. ZS, big spike, hitting near the highs. We're trading these inflection points here. The real inflection point trade out, the breakouts right now are seemingly coming from the financials. JP Morgan, Morgan Stanley breaking out, Goldman close to breaking. Oh nope, now breaking. Yeah, breaking out, new high. Is Bank of America part of that crew right now? Not quite. Looking for big banks that have already had earnings, generally good earnings. And then going to the regionals, like I mentioned with Regions Financial, that one looks attractive to me for a potential move to 26.5 range, 26.35. The Fed is a little bit cheaper on the premium. The March just gives me a little bit more time. I really should have been in it yesterday for 75 cents. Now that's 95, but it's okay. I'll keep watching it, looking for an entry point today. Maybe I can get in for 85 or 90 with some just market fluctuations. And maybe it's an end of day trade, because if we do get a little bit of risk concern in financials coming into the Fed and we dip before the Fed announcement, that gets me a good entry point, maybe around 24.90. And if we follow through, I'm just going to have to search around for another one. And it could be, Zion. Oh, I'm on the 5-day chart. It could be Zion, which is pressing for a breakout, or it could be KeyBank, KeyCorp. That's just below the 50-day moving average right now, looking like it could be, another catch-up kind of candidate if financials on the whole are strong. So, got to keep looking at them, keep working on them. Summary: IBM 215 and 240 looks good to me. ETN on the put credit spread looks pretty good to me, and love with that potential for a move up to 35 or down to 28.5 range looks intriguing. If they're weak like JetBlue, there could be that bigger move. So, but that one, like I said, I think just the strangle rather than the Iron Condor, looking for a big move there and not bothering with selling the 6-cent options and the 7-cent options. All right. Any last stocks you guys are looking at here before I jump off for the day? I should pull up eBay. So I do have a little bit of eBay, not a lot. And it's continuing firm here. So just going to keep holding that. If we get back to 69, I'll probably use that as a profit target to just to go ahead and look for some exits there. Good follow through after last week being a choppy week. It had a good reaction on Monday and then follow through today. JP Morgan still hanging on the breakout. Riot. Twilio just hanging up there. Getting a little bit of recovery in some of these WMB type names, but their implied volatility didn't go up enough like ETN where I'd want to do a put credit spread. So, all right. If there's nothing else from you guys, I am running out of ideas for now, but I'm sure there will be a lot of new ones tomorrow morning as we get through some big tech earnings, an FOMC decision, and set up for more big tech earnings. So, good luck with your trading today. I believe Vlad will be on for the afternoon for the closing bell, and I'll be on for the morning bell tomorrow. Okay? So we'll chat tomorrow morning. Have a good one, everybody.